This is one question we have taken from September, December official past exam paper from ACCA. Topic for today is interpretation of financial statements. And a very important topic. It is very frequently tested in exam. And unfortunately, this is one area where most students, they lose marks. They lose marks not because they cannot calculate the ratios. They lose marks because they do not understand the scenario, and they sometimes find it difficult what to write, how to write, where to start, where to finish, how to make a conclusion. So it's a discursive thing. And always remember that ratio calculation, if you are calculating the ratios, it has less marks, and discussion and analysis has more marks. Before I start doing this question, I just want to give a 15 minutes overview. I mean, question, actually, you can see the solutions are also given on the ACC website. So provide is not really something which is a very, a unique job. Of course, we'll do it together. I will show you how to read the question, how to approach the question. But before we do questions, let's understand that what ratio analysis questions, how you should approach it. And how you should approach it before that, what usually are the issues in the question. So first we need to understand that when you get a ratio analysis question, what usually they give you and what do they expect from you. So they can give you, financial statements of one company in comparison to another company. So company to company comparison is possible. It is also possible to make a comparison of, financial statements, and I would say trend analysis. Trend analysis. And let me just put it here as number one. And here I should say financial statements, and not trend analysis, but competitor analysis. And number three, I would say, is industry analysis. So you should very much understand that what type of analysis are you going to give, because your approach will depend on this thing. Of course, there will be some theoretical part of that. So you've got some background, what is the company, and then they give you certain other conditions. So of course, there is a scenario which is explained to you, and you must read that scenario. But primarily what you are going to do, trend analysis means that you are comparing your own performance with the performance of, your own performance, current performance as compared to the last year performance. You call it trend analysis. So here, you are not talking about any other company. You are only discussing your own company. How did you do last year, and how did you do this year? So your 2-year performance. And naturally speaking, there are some changes, because if everything is going very smooth, why do they make the question? They make the question because in the 2 years, there are few things which have changed. In the financial statements, some numbers, they have abnormal behavior. Some numbers do not look normal. And why do they not look normal? We will discuss that. The second thing is they give you a competitor analysis. Company A and company B. You are a bank, Alpha Bank, and there is another bank, which is a Beta Bank. So they ask you to make a comparison between one company and another one company, 1-to-1. And this has a different approach. And the last situation is that they give you your Alpha company or Alpha Bank as compared to the industry comparison, like not one Beta Bank, but overall the average of the banks. And your approach in all these three things should be naturally different. The things which you should be looking at and the things which you will be interpreting to. I give you a very simple example. It may not look very appropriate here, but it would help you to understand. When you see that there is someone who is coughing, so immediately what comes to your mind that this person is coughing, maybe he has been drinking very cold water, maybe he is suffering from flu, or maybe he is a smoker, and that cough is a symptom of some reasons. So these are three common reasons. There might be some special reason, maybe some allergy, which is a very specific reason, but generally what comes to your mind, and if you have to write down on this, you would start by saying that these could be the reasons for that. Similarly, if you see a car accident, you find out that there was a car accident. Generally what comes to your mind that probably the person was overspeeding. This is one reason of a car accident. Or maybe the person was not attentive, he was talking on mobile phone, he was using mobile phone, or probably he was not following some other typical driving rules, like giving indicators and stuff like that. So there are some common things which are always common. And the same happens in business. When performance, they go up, they go down. There are few analysis part, interpretation when we will do. I will tell you that these are the specific things, general things, which would generally fit in all the scenarios. So you have an overall scenario. In that overall scenario, probably there is 1 or 2 factors which are very much related to this situation only. But trust you me, there are 3 or 4 factors which that they would fit in all those situations. So if you know these 3 or 4, at least you know that even if you miss one of them, the specific factor you couldn't understand or you didn't understand, but you write down the general factors as well, which usually are available in these situations. So some part of the job will become easy. Now, when I say the first one, now how you should approach. If you have this first situation, financial statements of trend analysis, when you are comparing your current performance with your past performance, and we say that definitely from 1 year to the second year, there are some changes in the financial statements, and those, these numbers in the financial statements, these actually are the result of the events which have been happening during the year. When you see 2 years profits, 1 year profit is going down, profit is going up. So all of these numbers, they did not come just straight from your calculator. These numbers are a result of the events which have taken place during the year. If these numbers are going good, so it means that the events have been in your favor. If these numbers are going down, it means that those events were not in your favor. So generally what you need to look for when you do financial statements trend analysis, you should be looking at if the business has launched a new product, or project. This is one reason for good or bad changes in your financial numbers. I mean, your profits, they may go up, they may go down significantly as a result of starting a new product or a new project. The new project or the new product is successful, your profits will go up. It is, loss making, your profits will go down. So, I mean, if you do not do anything new and you continue to work the same way, your internal business environment remains same and the market remains same, then results should also be the same. The results will only change when either internally something is changing or externally something is changing in the market. I mean, there should be a change in the market, either internal or external. Only then your financial statements will show some, extraordinary change. If everything is working like before, my internal and the market conditions, everything is same, the numbers should also be more or less the same. So always look for the new project or the new product and make analysis on that. Then probably you can say that change in management. This is also one of the reasons in some situations that the company has changed the management, and the new managers, the new management, whoever has come in, they either are doing very good or they are doing bad. This could be one result in your financial statements. Or probably a new competitor in the market. So you are doing as before, the market is also as before. It is just like a new competitor has come in, or you can call it a new competitor or new technology. So new competitor or new technology, they will somehow, impact or affect your performance. This could be a third reason. There may be some other situations as well, and I will write down as more things will come to my mind, but these are generally the things from one year to another year. Last year was this year we either started a new product, or we changed the management, or the new technology has come in, maybe a new competitor has come in, or maybe there is an overall change in the business environment, change in the external business environment. Like you can say that in these days, COVID-19, the businesses, they have the same products, the same projects, the same managements, but they are not doing good. Nobody is doing good because of COVID-19. Your tourism industry is gone, airline industry is gone, hotels, restaurants are gone, shopping malls are gone, parks, amusements, and cinemas, theaters are gone. So everything, education has an impact. I mean, all the businesses are affected, except for these B95 masks, or except for the medical medicines which are used for the treatment. So if you see that because of this overall change in the environment, few businesses will suffer and few businesses will gain. For example, medical facilities, COVID testing, 19 labs, probably masks, and probably vaccines, they will make a lot of money, but others will lose. So you have to understand from the scenario. Listen, like I said before, calculation of ratio will always be easy. We learned calculating of ratios even in ACCA F3. So whatever ratios you had in F3, there is no new ratio except for few. Like you have few market-based ratios like EPS and price earning ratios or dividend yield ratios in F7, which were not in F3, but otherwise all other ratios are same. I mean, I am not here to teach you how to calculate ratios. Of course, we will calculate, but here, what my purpose is not to teach you how to calculate ratio, but to tell you which ratios you should calculate and how do you interpret it. And your interpretation will depend on your understanding of the scenario, that how well do you understand the scenario? Because if you do not understand the scenario, you cannot write it. In order to write about it, you need to know that how to understand the scenario. So this is a financial statement, trend analysis, what you are looking at generally. If I go for the second part, the second thing, financial statements, competitor analysis. When you make competitor analysis, which things you are focusing at? They tell you that your company has a current ratio of 1.6, competitor has a ratio of 1.8. Your company has a gearing of, 0.4, they have a gearing of 0.6. This type of information is there. Your ROCE, competitor ROCE, your profitability, competitor profitability steps. One company, alpha with beta. You are comparing alpha with beta. So which things you are generally saying at? You should be looking at differences in accounting policies. And by the way, this differences in accounting policy should be here as well. Because it is also possible that in this year, you have changed your accounting policy and as a result, your numbers have changed. Accounting policy means maybe you are doing revaluation. Before you were not doing revaluation of assets. As soon as you do revaluation of assets, your assets go up, revaluation surplus increases, revaluation surplus goes up, it means equity increases means gearing changes. So changes in accounting policies is always one reason you should be paying attention to. And you have to write down just two lines, one line, two line on any such particular area. So when you are comparing alpha with beta, if you are comparing alpha with beta, you should always be thinking about how alpha is accounting the books and how beta has accounting policies. How do they, ownership of assets. This is one very important thing. A very common thing, ownership of assets, because they say that alpha company has owned this much of, Alpha is a hotel company which usually has properties in its own ownership. Beta is also a hotel chain, but they lease out or they rent out this thing. So when you have a difference in ownership, one is going depreciation, one is giving rent, it is going to create some impact. So you talk about ownership of assets, you talk about capital structures, who has more equity, who has more debt. So we talk about differences in accounting policies, we talk about ownership of assets, we talk about their capital structures. So this is usually what you are looking at when you are doing with a competitor analysis. I will speak a few more as we move on, but I'm just writing down here because I just want to move to the question, and while doing question, we'll speak more. Financial statements, industry analysis. So industry analysis, it means that you are comparing alpha with rest of the industry. Rest of the industry means that in the local market, there are 35 banks, including Alpha. Alpha is your bank. So you put Alpha on one side and you are comparing Alpha with the average of 34 other banks. So you are comparing it with the industry. Industry means all of the companies together, their average. So here again, the same point, difference in the accounting policies and uncertainty about the accounting policies. Not only the differences, but uncertainties. Because if you compare alpha and beta, so you know that alpha is using cost model, beta is using revaluation model, so I'm clear. But when I'm talking about industry, there are 34 banks. So I'm not sure who is doing revaluation model, who is doing cost model, because now there are 34 of them. So there are not only differences, but there are also uncertainties in the accounting policies. Like we say that the financial statements, the differences in the numbers are not only because of the real performance, but it is also because how the financial statements were prepared. It is also possible changes in dates of financial statements. I mean, you close your financial statements on 31st of December. In industry, some are closing on 30th of March, some are closing on 30th of June. So this thing also creates some differences in comparisons, because you are closing when you have a off-peak season, other have peak season, etc. So these are some common areas. I'm going to add a few more points into this list as we move on. But we say that three type of scenarios you should be looking at. I mean, three type of situations. You should be very clear that what the question is about. Is it about a trend analysis? Is it about a comparator analysis? Or is it about industry analysis? And your approach will be different in all these three scenarios. So let's start reading the question, and then we will discuss them more. So it says that I'll read it for you, and then I will give you some time to comprehend it, because reading is not important. Comprehension is very important. And by the way, let's first read the requirement. The question has 3 parts. Total, there are 20 marks, 7, 10, and 3. Part A, adjust for the information in note 3 and calculate the 2007 sector average equivalent. Sector average. So it means we are doing industry analysis. Sector average equivalent ratios for one company. So this is our company, one company, and we are going to compare it with the industry. So we are not going to have trend analysis or comparator analysis. We are going to have industry analysis. But before that, it says adjust for the information in note 3. So it means that there is some information in note 3 which we must read, and then we should find out the ratios. And we do not make any comment. He does not say you to make commentary, because in this question, part B, it says assess the performance. In part A, it does not say discuss, assess, comment, nothing. He says adjust for the ratios and adjust for the information and calculate the ratios. That's all. So you are not going to make any commentary here. No discussion, just numbers. So let's read the numbers now. This scenario relates to 3 requirements. One company is a bakery which also owns 2 shops and cafes. Owns. This word is important. Always remember, the answer lies within the question. I always say that answer lies within the question. You see what? They could have told you that one company is a bakery. That's all. This sentence is complete. This sentence is complete. One company is a bakery. That's all. Over the last 2 years, the company has experienced declining profitability. This is perfectly fine. But you see, he's giving you this extra sentence. The answer lies within the question. They always give you a clue what to do. What do you think? What is the most important word? This word is important here, because it says which also owns shops. So you have you have ownership of assets. Owning assets and not owning the assets, it makes a very big difference. You should understand, it is not a joke. I mean, you own a car and then you use it as a rent-a-car, or probably you have leased a vehicle and you are using it as a rent-a-car. Do you think that you are going to get the same results? Of course, you will not get the same results. So anyways, pay attention to these little words. One company is a bakery which also owns 2 shops, cafes. Over the last 2 years, the company has experienced declining profitability due to increased competition, and so the directors wish to investigate if this is a sector-wide problem. So over the last 2 years, the company has experienced declining profitability, which means that before it was doing good. Only in the last 2 years, it has gone down. And the directors, they want to investigate that if it is only with you, or is it the sector-wide overall environment problem. Consequently, they have acquired equivalent ratios for the sector, some of which have been reproduced below. So they have given you these ratios, 1, 2, 3, 4, and 5. So it is very helpful. Now, you at least know that these are the ratios for the industry, for all the bakeries together. For one company, you will also need to calculate the same ratios. So this is a kind of a help to you. Otherwise, you would be sitting and thinking that which ratios I should calculate. So again, my statement is there. The answer lies within the question. Answer lies within the question. They are telling you, listen, ACCA knows that this exam is taken by students. ACCA knows that working professional with 50 years of experience will not come and take this exam. They give you a lot of clues within the question, if only you pick up those clues. The first clue was this one. The second clue is, please find these ratios. So when they give you these ratios, what are they telling you? They are telling you to find out these same 5 ratios for one company. So that's very clear. Thank you very much to the exam setter. He made life easy. And then we move forward. So let's first have a very quick look. Return on capital employed 18.6% in the market, operating profit margin 8.6%, net asset turnover 2.01. Net asset turnover means net asset to sales ratio, or sales to net asset ratios. Inventory holding period is 4 days. It's a very short time period, but I know that it is bakery products. So in bakery, maybe 4 days is enough. And debt to equity ratio is 80%. Debt is 80% of equity. That's too high. It looks good. Operating profit margin is 8.6%. It means that you have got huge interest payments. That's why it is too much. I mean, the business is giving 18.6%, and then it is operating profit margin is just 8.6%. Interest payments are huge. Anyways, we move forward. The following information has been extracted from the financial statements of one company for the year ended 31st December 2007. Revenue 100 million, 3 zeros are there. So it is 100 million 800,000. 70 million is cost of sales. So 70% goes into production. Gross profit is 30 million 800. Operating expenses are 17, and the profit from operations 13. So if I compare from here, my net operating profit is 13 point something percent. Okay, 13%. What was for the industry? If I go back and see, industry has operating profit margin of 8.6%. We have operating profit margin like PBIT divided by this thing of approximately 13%. So we are doing good. From here, ROC, I don't know, but at least this I can find out. Operating profit, we are doing good. One company is doing good. Okay. Anyways, we continue. Statement of financial position, non-current assets, inventory, equity, revaluation surplus, retained earnings, non-current liabilities, etc. Now we start reading. Now, if you pay attention, it said that adjust for the information in note 3. So actually note 3 is more important for us, but let's read note 1 and note 2. Note 1, it says in 2006, one company acquired a popular brand name, which means last year. At 31st December 2007, the brand represented 20% of non-current assets. The remaining 80% of non-current asset comprises of the PPE, property for which one company operates its bakery and shops. This property is owned by one company and has no directly associated finance, which means that there is no mortgage on that, there is no debt related to that, you 100% own the property. The property was revalued in 2004. Very important information, revaluation. So assets revaluation. In the year ended 31st December, one company began offering discounted meals to customers. One company hoped this strategy would help to reduce perishable inventory and reduce inventory holding periods. Okay, so in 2007, current year, they have started giving discounted meal deals to customers. And why they are doing it? To reduce the inventory holding period. Maybe their inventory holding period is high, so they want to just sell the inventory fast, so they are giving discount. In January 2008, it was decided to discount some slow-moving seasonal inventory, which had a selling price of 1.5 million. Under normal circumstances, these products have a gross profit margin of 20%. The inventory was sold in February for 50% of its cost. 50% of the cost. We don't know the cost. We know the selling price. We know the selling price. We know the margin. We can, based on selling price and margin, we can calculate the cost. And then 50% of the cost. It means that you are selling it at a loss. Okay, it's very important. It is not that you are just losing profit. You actually are making a loss on that. One company to produce. The financial statements for the year ended 31st December were authorized for issue on 15th March. So that is also a very important point, because you sold these goods in February. Financial statements you are making in 31st of December. 31st of December 07. Goods you are selling in February 08, which means that after the financial statements. But then you have March 08. March 08, your date authorized for issue. So it means IS 10, events after the reporting period. If you remember the standard, events after the reporting period. Although you sold these goods in February 2008, although you sold them after the financial year was closed, but you still will make it an adjusting event under IS 10, events after the reporting period. And this is what they ask us. Note 3. They said that adjust for the information in note 3. So this is note 3. You are making a loss. So adjust for that loss and then calculate the ratios. Okay, we understand. Anybody has got any question until here? Please ask. Who else is here? Okay, let me ask. There is a question. So we start with our requirement A, which says that adjust for the information in note 3. And what they told us in note 3, that what happened. I'm repeating it again because before we read the full question, in note 3, they told us that there was some inventory which was for 1.5 million. And under normal circumstances, these products have a gross profit margin, not markup, margin of 20%. Margin means 20% of the selling price. The profit was 20% of the selling price, which means 20% of this 1.5 million. And the inventory was sold in February 2008 was 50% of what it had cost one company to produce. So they did not give us cost, but we can calculate like this: selling price minus the 20%, you will get the cost. And you are selling it at 50% of the cost, which means you are making a 50% loss. Okay, you are making 50% loss. Let me write down here, and I will say here, let me find out this requirement A, and what we are planning to do. Let me first find out the numbers, and then we will make a little bit of statement, not very long statement because we are not required to make comments. We'll say that loss on inventory. So selling price was 1.5 million. So usually I write down 3 zeros on the top. So selling price is 1.5 million and margin was 20%. So it means that this multiplied by 20% into -1. This was your profit and this is the cost. We can say that cost of inventory. And then we say sold for. How much you sold for? You sold for 50%. They said that you sold it at 50% of the cost. So 50% of the cost means that you are selling these goods at 600,000 and there is a loss on valuation of inventory. Okay. So on inventory, you are making a loss of 600,000. Now that is something very important. You need to understand. You are making this loss because the goods cost you 1.2 million. You sold them for only 600,000. So you made a loss of 600,000. So this loss is happening where? Now please understand, this is not what you are going to write down in exam. I'm just telling you here now. Your SOFP date is 31st December 2007. Your loss date is February 2008. And your authorization of financial statements date is 15th March 2008, which means that you booked the loss before the financial statements were authorized for issue. So under this condition, we will make 2 lines I would like to write. And by the way, when you have to write down the discussion part, it is never difficult. Whatever you are thinking in mind, like you have some thought process is going in your mind. Okay, I should calculate this, I should calculate that. Just put it in words. Put that in words. This is your explanation. You would say that one company incurred a loss of 600K, let me write down like this, or 600,000 during February 2008, which was before the date of authorization. Under IS 10, events after the reporting period, this should be considered as an adjusting event. And therefore, we need to make changes in the financial statements prepared on 31st December 2007. According to IS 2, inventories should be measured at lower of cost and NRV. In this case, cost is 1.2 million and NRV is 0.6 million. And therefore we would value inventory at 0.6 million. So this is what you should be. Very simple, 1 line or 2 line, whatever. Now you should say that impact of the loss on inventory, how it is going to make impact to you. Now, you know that any loss in inventory should be charged to cost of sale. Inventory, it goes to cost of sale. So any losses on inventory should also go to cost of sales. So we should say that. So you have 2 options here. It will depend on your choice. How do you want to present? You can take the numbers, like these numbers we have here, revenue. And by the way, I can shift these things a little bit up so that I don't have to scroll a lot. I can take them here somewhere. So I can say that we have been given these numbers here. You can remake your income statement with these 4 lines. You can remake income statement with these 4 lines, which would not take a lot of time. It will just make a very quick thing. Let me drag it down so that we don't scroll a lot. So I would say here, revenue, cost of sale, gross profit, then I have my operating expenses, and I have my profit, okay? Or I can call it PBIT, profit from operations. Would say, as per financial statements, change and revised. So as per financial statements, what they have given you, revenue was 100, this one, 70,000. You can do it a little bit fast in exam. I'm just not doing the question, I'm explaining the question. So then you have this, your, operating expenses, and you come to your net profit. This is here. So there is no change here. So I can just leave it simple, and I make a total. There is a change of 60,000 or 600,000. So how do you write down 600,000? Be careful with the zeros. Just write down here 600, okay? Like 600. So that when you make a total, it becomes 70,600. Your cost should go up and your profit should go down. And then when you talk about operating, there is no change, and we'll make like this, and we make a total. So we'll say that the revised profit after this thing is this much. Now what we are going to use these numbers. Our PBIT, which was given in question, was 13,160. But for the purpose of calculation of ratios, we will be using 12,560 because the loss on the inventory would increase the cost. That loss, where should you show that loss? Into your financial statements. Your expenses will increase, profit will decrease. So 12,560. So this is actually the impact of inventory on P&L. And then I would say impact of the inventory on SOFP, where it will impact the inventory. So you had inventory, and how much was the inventory given? It was given 3,960. Impact is 600. You have to decrease. So decrease the value, and your new inventory should be 3,360. This is what we will be using. And by the way, there is one more thing which will be impacted on the balance sheet. Can somebody tell me, on the balance sheet you have these numbers? Which other thing will be impacted by 600? Can somebody tell me? Retained earnings. Why retained earnings? Can somebody explain that point, please? What is the retained earnings? The retained earnings is 10,480, right?
Yeah.
Where it comes from, by the way?
It comes from the PBIT.
It comes because whatever profit you make here in the income statement, profit, not only this profit, but you pay interest expense, you pay taxes. So whatever profit is your net profit. That net profit actually comes here. So, and therefore, if my profit will go down, my profit has decreased, it means that my retained earnings will also decrease. So we put here retained earnings. So as per question, it was 10,480. And of course you decrease it. And you can see it very closely now that on the balance sheet has two sides. Inventory comes here and retained earnings come here. So from inventory, you subtracted 600. And from retained earning, you should also subtract 600. Otherwise, your balance sheet will not become equal. So this 600 should be subtracted from two sides of the balance sheet. One from the asset side, one from the equity side. So this is the impact of this thing. Your part A is done. You don't need to do further anything in this part A. Because in part A, it only said that, if you go back and read part A, it said that adjust for the information in note 3. So we have adjusted for the information in note 3 that $600,000 we subtracted from income statement and from the balance sheet and calculate in 2007 sector average ratios. Okay, I'm sorry, we have to do this part. We have to find out the ratios. Now we find out the ratios. And you know which ratios we need to find out? Which ratios?
The ones given above.
The one they have given us. Not here, but there. They made our life very easy. They told you exactly which ratios you have to calculate. So let me drag it further down. Give me a minute, please. Please pay attention. I am taking more time because I see that you are 17 people signed in here, and I take responsibility of explaining everyone. So I'm speaking very slow. I'm doing very slow. When you are in exam, you have to do it faster. So you would say ratio comparison of one company with the industry. So which ratios are there? ROCE and PBIT, operating profit margin. Then you have net assets turnover ratio. Then you have inventory holding period. And then you have debt to equity ratio. So very simple. These ratios, they already told us we have to find out. And I can write down here industry. And here I will do it for one company. So for industry, it is given 18.6%, 8.6%, 2.01, and 4 days, and 80%. Now, I'm sure that you people remember the formulas for these ratios. How do you calculate ROCE? ROCE, the formula is PBIT divided by capital employed. So there are two ways of doing this presentation, that you can write down the formula in the one and you can write down the numbers in the second. You have this option. If you don't want to write down the formula, you can straight write down the numbers. And what is the PBIT number for here? So how much is your PBIT, profit before interest and taxes? It is 12,560. So you should be taking the new one, okay? So it is 12,560 and divide it with the capital employed. What is capital employed? Can somebody tell me? How do you calculate capital?
Total assets minus current liabilities or equity plus long-term debts.
Perfect. Capital employed means total assets minus current liabilities. This is one way of seeing it. Or you can say equity plus non-current liabilities. So which one information they have given us? So we can take these numbers. This is your equity and these are your non-current liabilities. Should I take this equity here?
No.
Why?
You have to adjust retained earnings.
Yes, we should subtract that 600 because it includes all retained earnings. Great. So you guys are doing good. So what we should do, 32,880 minus 600 plus 14,400. So this is the number we should be taking. And because it is in percentages, you can use the percentage thing also. Let me take it like this. What is there on the top? Okay, I'll keep it here. So then I take this number and I put it here. And I put equals to sign. It gives me 26 something. I press this percentage sign and always use two decimal places. It is 26.91%. while calculating the number, I can immediately see that one company is doing amazingly good as compared to the industry. We will speak about it in next part. In this part, they do not ask you to make analysis. We don't make analysis in part A. Then we talk about PBIT. Okay, PBIT in industry, it was 8.6%. And how much PBIT is there? So we calculate PBIT divided by sales. So how much is PBIT in our case?
12,560.
We took it here, 12,560 divided by the sales figure, which is 1,800 or 100,800. And I put it here, it gives me 12 point something, 12.46%. This is also better than the market average. Then you have net assets turnover, which is 2.01. So net asset turnover means sales divided by net assets. So how much are your sales figure now? Sales figures are 100,800 divided by net assets. Net assets means equity divided by equity, or net asset means, total asset minus total liabilities. You can take any of these numbers. So how much net assets do we take? Equity was how much of the equity? 32,820, they said?
46,680.
Yeah, I would use 32,880 minus 600, okay? So this is the number I'm taking. So it gives me 3.12. Net assets, 3.12 times. So it says that, what does it tell you actually? Net asset turnover, it tells you that what are your sales in relation to or as compared to your assets, net assets. How many times you are rotating your assets? Okay, then you have inventory holding period. And how do you calculate inventory holding period? Inventory holding period would be your inventories divided by your cost of sale. The formula is inventory divided by cost of sales. Now, here you should pay attention. This inventory divided by cost of sales, it is also possible that sometimes you don't have information on cost of sales, so you divide it with purchases. It is also possible that you don't say inventory, you say average inventory. So by the way, when you will do interpretation with competitors or interpretation with industry average, you must sometime make this comment also that there are several ratios which have different methods of calculation, like inventory days, receivable days, and payable days. Some businesses, they calculate based on closing inventories. Sometimes businesses, they calculate based on average inventories. So we don't know how this industry has calculated. Are they calculating it on closing inventories or average inventories? And the same thing happens with gearing. So there are different methods of calculating gearing ratios. So in our case, inventory was, I think we made an adjustment of total inventory was 3,960 minus 600 and divided by your cost of sales, which was 7,600. So this is the formula here. And you actually should multiply it with 365. If they do not tell you, sometimes they tell you to multiply with 360 working days, etc. If they do not tell you, you multiply it with 365. So now if I see here, that is a disaster almost. That is, I would call it a disaster, because in market, overall, people are keeping inventory for 4 days. These are bakery items. I mean, you sell them very frequently, very fast. You have got 17 days inventory holding period, which has 2 impacts. Your investment is blocked, so it means that your profitability goes down. Your goods are remaining on the shelf. It means you have risk of loss also. So we have to speak on this thing. This number we do not like. And then we have debt to equity ratio. So debt to equity, very simple, debt divided by equity. Nothing else, debt divided by equity. And we have been given that this is debt is non-current liability, and this is equity, minus 600. So we calculate here, we say that 14,400 minus 32,680. No, 32,280, because we subtract 600. So debt to equity, not minus, I'm sorry, divided. So it is 44%. And I convert it to numbers, it is 44%. It is very healthy. It is very healthy because overall people, they have 80% debt. We have got only 44% debt. So these numbers are done. Your answer to part number A is finished. We took quite a lot of time, but again, like I say, that my purpose is not doing question. My purpose is explaining the question. So once you have done with that, the next thing which is most important is for interpretation of these numbers. Because in part B, if you pay attention, this was only 7 marks. The next is 10 marks. It is even more interesting. Now 10 marks means that you have to spend approximately 20 minutes on this. So there are 1.95 minutes for each mark. For each mark, you have approximately 2 minutes, 1.95 minutes. So when you see a 10 marks question, it means that there's a 20 mark thing. I would suggest out of these 20 marks, I should keep like 4 or 5 marks for planning, minimum 4 or 5 minutes for planning, and then 15 minutes for writing. Your planning is very important here. Okay. See here, if there is any confusion about this net asset thing, let me explain. In one of the ratios, we use capital employed. In one ratio, we use net assets. So please understand the difference between capital employed and net assets. Capital employed means total asset minus current liability. So total asset side minus the current liability. That is called capital employed. Capital employed has one more calculation. You can say capital employed is equal to equity plus non-current liability. Like you take your equity, which is this one, plus non-current liability. This was non-current liability, if you remember.
Good.
So this is, if I take it, this part, only 32. This is net assets. If I add these two together, it becomes capital employed, non-current liability. So this is the capital employed. Net assets, how do you write down? You say total assets minus total liabilities. This is one way of seeing it. And another way of seeing it is this, just equity. That's all. Net asset means equity. So in this question, they are telling us that this is equity. So this is net asset, and I took this number. I just subtracted 600 because of that retained earning number, 600 from inventory. Just take this number. There should not be any other confusion on that.
So I think I asked you one question. Is that
okay? So we are done with this part A, and we go to part 2. In part 2, it says assess the financial performance and position. Financial performance means the ability to make profit. Financial performance means profitability. which means income statement, and position, it means balance sheet. So assess the financial performance and position of one company for the year ended 31st December in comparison with the sector average ratios. So now you have to do for 10 marks this, how to say, comparison. So how do I see that? I know that I have to make a comparison on income statement and I have to make a comparison on balance sheet. And together there are 10 marks. So I can fairly assume that 5 marks are here and 5 marks are here. Then within income statement, I have like to gain out those 5 marks, I must give maybe 2 points or maybe 3 points. And for these 5 marks, again, I will highlight 2 or 3 points. So this is how you should be thinking about where to structure. And you will write down 1 paragraph for income statement. Please do not try to write in bullet points. Don't write down in bullet points, write down in paragraphs. 1 paragraph for the balance sheet. And you can make 1 paragraph for the conclusion, maximum. This is how you should be planning it. So if you talk about income statement, so where do I start with? I know that these 2 things, they are related to financial performance, and these 3 things are related to financial position. So I'm going to speak these 2 things first. In the paragraph first, when I'm talking about financial performance, so we would say financial performance of one in relation to the industry. You know, you should always write down as if you are giving explanation to someone, and do not write down incomplete sentences, write down full sentences. I'm sure that you can write down correct sentences. You don't have to be very super on language. This is not an exam for language, so don't think of using difficult words. Use simple words, which is called business English, which is the easy English. But your how to say layout should be very clear, like financial performance, and then I would say financial position. So anybody who is reading it, he knows what you are doing. If I do not separate that, then everything will be mixed up, and I will call it conclusion. Now, I've not started writing it yet, but you already know that what do you expect here. So these 2 lines, which are related to income statement, these will be written down here. So let's start writing it. What do you see? We can see that one company has these numbers better. Always what you do, first you make interpret, which means that analyze, okay? Which means analyze and explain what is good, what is bad. But everybody can see it. If you say that, you know, now this is where students, they make mistake and they don't get marks. You know what students will say? They say one company has ROCE 26.91, which is more than the industry, and it is a good sign. This is nothing. I mean, I can see that 26.91 is bigger than 18.60. You don't have to write and tell it to me. So if you write down that one company has 26.91, which is bigger than industry news, thank you very much. It's a very big news which you are giving me. I mean, I'm not expecting this from you. I can see. Please tell me why it is bigger, what would be the reason, or what precautions you should take. So always do interpretation and do precautions. You remember there is one topic which is called limitations of financial statements. We said that sometimes the information presented in the financial statements, it may not give the true or correct picture because of some limitations. Please read that chapter and listen to that video, limitations of financial statements. So precautions, which I would say limitations, let's call them like this. Precautions and limitations you have to give, okay? So step 1, you interpret. I will do like this. I would say that the financial performance is reflected by 2 key ratios. One is PBIT and the other is ROCE. We can see that. So first ratio, I will go in the same order. First is ROCE, so I will speak about ROCE first. We can see that the ROCE of one company should mention 26.91, must mention. You should write down, because it is possible that the reader does not have this part. Maybe the reader is only reading from here. So you cannot assume that you write down that one company is more than, if I say that one company, ROCE of one company is more than the industry, and I put a full stop, that's a bad narration. It is more than the industry. How much more? I don't know. You cannot tell me. I'm your boss. You give me this answer, okay? I see that. Where's the one company? How much it is more? And then you say, please go and read back from there. Why should I read back from there? Can you not write it? Please write it. That the ROCE of the one company is 26.91%, and the industry average is 18.60%, 18.6%, okay? We can say that. So how much it is more? If I consider it is more, it is 18.26. The difference is 9. It is approximately, which is approximately 30% more than the market average. Having a higher ROCE is a good sign for investors and the managers. However, we must consider that there could be other reasons for having a higher ROCE. ROCE is a result of PBIT, which greatly PBIT and capital employed. So ROCE is a result of PBIT and capital employed, and we know that PBIT depends on accounting policies of a business. And the same goes for capital employed. So I'm just here speaking in general. So what I did. First, I said that ROCE is higher, and why this ROCE is higher, we will discuss it later. And then I said that higher ROCE means it is a good sign. But then we say that you cannot totally rely on ROCE because ROCE depends on PBIT and capital employed, and both these numbers, they depend on the accounting policies. Capital employed. Now I will give examples. For instance, in this case, we know that one company has recently revalued the assets, and there is a revaluation surplus lying in the capital employed. If the one company has not revalued the assets, then this ROCE would have been even more. Because in your case, you are calculating 26.91 based on equity, which you are taking this 32,880, and it includes the revaluation surplus. If they had not done the revaluation surplus, this number would have been 27,000, and your ROCE would have been even more. So ROCE, you can write down even more, even less. I just stop it here because I need to do other parts as well. Then I will talk about in case of PBIT. Again, the one company has, how much is that? One company has 12.46. Okay, has 12.46%, whereas market is just 8.6%. Okay, so market is 8.6%. This shows one company's better financial performance against the industry. It could be due to the reason that one company might have better control over expenses. So now you need to speak about why or where it is coming from. So we can say that either you have a better control over expenses. There's one more thing which was given in the question. In the very beginning, I said that it also owns two shops, ownership of assets. So this is the point, because ownership of asset, it puts you in a position of, in your financial performance, it is reflected. I would say one reason could be that one company owns its shops and cafes and does not pay rent. On the other hand, in market, maybe other companies do not own and pay high rentals, which have resulted in lower PBIT. Okay, now this is what is related to this particular question. Now, whenever you are calculating or whenever you are speaking or writing about profitability, always write down some advantages and disadvantages of higher or lower profit. For example, you can say that, what I would say, the higher PBIT puts one company in a position to outclass its competitors on pricing. They already are making huge profits, and they are, or no, not huge profit, they would say that since their profit margins are more, therefore they can offer some discounts to increase their sales, This discount offering will also solve their problem of slow moving inventories. You know, they have slow moving inventories, to solve the problem of higher inventory days, because they have 17 days in inventory, higher inventory days. So always remember, when there is when you see that a company which you are analyzing, they have low profits, so you should say that, you know, the low profits put the company in a very vulnerable position. If the competitor will give discount, they will not be in a position to give discount, and they will lose customers. So this is one step standard. Like I was telling you, that when you have fever, there are some standard symptoms. That why do you have fever? Similarly, when you have higher profits, when you have lower profits, there are some standard options which are available to you. And all companies, they use the same options. I mean, whether you are a telecom company, you are probably a restaurant, you are a hotel, you are an airline, whatever you are. If for some reason you are in a position where your profit margins are better than your competitors, what naturally will you do? Whether you are one company or you are some company does not matter. Whenever you have higher profits, what do? You kill your competitors by giving extra discounts, because you have got margins in your hand. He can reduce the price by 10% or by 5% and still make profit. But the others cannot make 5% discount and still make profit. So you should always be, whenever you are interpreting performance and you see that your profits are more, so you should say that this discount offering will solve the problem of high inventory days. Since their profit margins are more, therefore they can offer some discount to increase their sales. A very standard sentence. This sentence is not for one company. This is for all companies whenever they have. So this is all about financial performance part. Then you come to financial position part. Okay, one student just asked this question. I think that we are still getting concerned about how to calculate these ratios. See here, you have asset turnover ratio. Go with the name, asset turnover ratio. You have return on investment. Then what do you have? Then you have a capital ROCE, return on capital employed. When you talk about asset turnover ratio, so you have two words coming in here. One is asset and one is turnover. Turnover means sales. So you must use sales here. And asset means, of course, asset. Now, this asset turnover ratio can be calculated in two ways. One, you can say sales divided by assets. And the other one is, like you say, sales divided by net assets. These are the two possible things which you use. But definitely, you will not divide it with capital employed. Why these two options we use? Because sometimes the data is given. For example, in this particular case, I used this formula. Why did I use this formula? Because I can find out my net assets, which is my equity. It is given. But I was not sure about my total assets. When I say sales divided by asset, it means total assets. So do we have total assets? We do not, because they don't give us current assets like receivable and cash, etc. So this ratio, calculating this ratio becomes difficult. Generally, you should be doing this one. If somebody says calculate asset turnover, what immediately comes to my mind that I'm not doing net asset turnover. You are telling me asset turnover. Asset turnover means sales divided by assets. And when you say asset, it means total asset. So generally, I should be doing this one. But because in this question, they did not tell me any information about total assets. So therefore, I use this thing net assets. So first thing, you understand this. The second, you have return on investment. Now, when you talk about return means profit. Return does not mean sales. So it means that I should be using the profit figure. And which profit? All of the interpretation you will always do with PBIT. You will never divide net profit after tax. All interpretation you should be using PBIT as your operating profit. So return, which means profit, and profit means profit before interest and taxes. Always, always, always. You will never use net profit ratio. So in this case, I understand that I have to use my return over investment. Okay, now there is also a ratio. For example, they ask me to calculate return on equity. So if you say return on equity, so return on equity, I would use PBIT divided by equity. And equity means net assets, by the way. Net assets. If you have to find out return on equity. Now, you asked me the question that can I use here? What you asked me the question? You asked me question, can I use the ratio as sales divided by equity? Is this what you know? You asked me sales divided by capital employed. Sales divided by capital employed is no ratio. I mean, you can find out if you want to, but generally it is not a ratio in the list. These two ratios are the same. Return on investment or ROCE, return on capital employed. This is PBIT divided by capital employed. And this is also the same. You can call it PBIT divided by investment, but investment is the same as capital employed. Because when you were doing your ACCF 5 divisional performance, they will tell you that this is the investment. And actually that investment is kind of capital employed. So these two are very close or very similar to each other. They're very similar to each other. The only difference is that sometimes when we say investment, we only means equity. So these three are very close to each other. You know, PBIT or equity, PBIT or capital employed. What does that mean, capital employed? Capital employed means equity plus non-current liabilities, okay? So there is sometimes a little bit of very, very subtle difference in these ratios, in these numbers, which you need to understand. But if you ask me that for asset turnover, how would I go for? I would have gone for sales divided by total assets. If total assets are not given, I will do sales divided by net assets. But I cannot do sales divided by capital employed. This is no way. This is not which comes to mind, because we are talking about asset turnover, not the capital employed. We are talking about asset. Asset is different than capital employed. Asset is a much bigger thing. Capital employed is always smaller, because capital employed is asset, total asset minus current liabilities. So assets are always bigger than capital employed. Any question, please ask. That's why I'm here today.
Yes, sir. Okay, sir. I understood.
There will still be some confusions, because like I told you that many times there are some modifications in ratios. Like when you calculate your inventory days, how do you calculate inventory days? You have a formula. Sometimes you say closing inventory divided by cost of sale into 365. Sometimes you say, average inventory divided by cost of sale into 365. In some questions, they do not give you cost of sale. So you say closing inventory divided by purchases into 365. Or you can say that closing inventory divided by average inventory divided by purchases, closing inventory or average inventory. So either you can take cost of sales or you can take purchases. Similarly, either you can take closing inventory or you can take average inventory. Now, if they do not tell you in the question how to do it, so how would I go for that? If you ask me, for me, this is the best option. I would prefer this one. Average inventory divided by cost of sale into 365. But in order to have average inventory, they must also give me the opening and closing both inventories. If they're not giving, then I would probably go with this one. Purchases I will use as my last option. Similarly, you have issues with your gearing ratios. When you do gearing, you have either you say debt divided by equity, or you can say debt divided by debt plus equity. So you should look for in the question how they want you to find out. Are they asking you to, if they say you calculate debt equity ratio, if they say calculate debt equity ratio, then you will go for the first one. If they don't say calculate debt equity ratio, they ask me to calculate gearing. Listen, if they ask me in question, calculate gearing. That's all. Then what do? I would prefer this formula. This is my choice. If they only ask me calculate gearing. But if they ask me specifically calculate debt equity ratio, then I will calculate debt divided by equity. So these are some typical issues in the ratios, sometimes the numbers. But here we have no confusion. Asset means asset, turnover means turnover. Return means profit, and profit means PBIT. Never net profit, but profit before interest and taxes. Okay, clear? Then we go for financial position of one company. So financial position, again, now financial position, we have three things. Net asset turnover, let me copy them here so that I can see the numbers and we don't scroll them again. I put them here, okay? So let me just remove these colors. Or maybe I can keep a little bit slow, light color. So these are the numbers we are going to discuss on. Please mute yourself. Okay, so we say that as for the financial position, I will start with the most alarming thing. The most alarming number is with inventory holding period. I'll straight with that because I'm really concerned about that. And we'll say that one company has 17 days inventory holding, whereas the industry is having 4 days. Considering the bakery business, 17 days seems to be a huge period. It could be due to the fact that either the prices are more, which reflect or which is reflected in higher PBIT, or the inventory management is poor. I'm using the word poor. Specifically, I'm using the word poor because it is poor. I cannot call it is not good. I mean, if I am the manager, I would call it poor. That why do you keep the bakery products for 17 days? So, and one reason could be, if you see their PBIT was very, very high, which means that their prices were more or their costs were less. When do you have more profit? You have more profit when either the, listen, always remember, the balance sheet and income statement are related to each other. Balance sheet and income statement are related to each other. What happens on the balance sheet, it is reflected in the income statement. Or what is happening in the income statement, it is reflected on the balance sheet. They are very much related to each other. When I see that their profitability or income statement is 12.46 or their return on capital employed is 26.91, it means that they are making huge profits. And then I see that their inventory days are more. It means they are not able to sell the goods as fast as they expect. So they produce the goods because they thought that they would sell, but they couldn't sell. So therefore, their profit is more, but inventory is piling up. Now, tomorrow, if they have to write down this inventory. Now, remember going back to the question, what did they do last time? Last year, what did they do? If you understand. Now, where is this thing? Do you remember?
They offered discounts.
Last year, this also happened with them. On 31st of December, they had huge inventories. They could not sell it. And then they were selling it at a very low price and they become a loss. This was happening before also. Now, can you relate this scenario? And I say here, just like here, is poor. One sign of this was the writing down of inventory by 600,000 USD just in the beginning of the year. And this could happen again. And that is why their profits are more, because they are selling it at such a high price. So nobody is buying. So their inventories are lying there. So it is suggested that they should review the pricing policy as well as the inventory management to reduce the holding period. Otherwise, this perishable inventory could result in a loss. So this is about inventory. The second, which we need to talk about, is asset turnover. So we say that the asset turnover is slightly more than the industry average. Industry average, which could be due to better management of assets by the business. Okay, that's all. We don't need to write a lot about that. And then comes debt to equity. Debt to equity ratio is 44.61%, whereas the industry average is 80%. It shows that one company has less debts and more equity. One reason of this could be revaluation of assets, because as a result of revaluation, equity increases, and this improves the debt to equity ratio. So one reason could be this one, debt to equity. We can also say that lower debts means lower interest costs. This is one point we understand now. Because they have low debts, you see why they have higher PBIT? Now see, they have better PBIT. Are you people with me?
Yes, sir.
Yes, sir.
You see the PBIT is higher. Market has lower PBIT. What is the market debt? 80%. Their debt is only 44%. So when you have more debts, you are paying more interest. And that is why, no, but not interest, because it is
PBIT is
it is 40% taxes. So it has got nothing to do with that. I'm sorry. It's PBIT, so it has got nothing to do with the interest. So low debt means lower interest costs and lower risks in future. That's all. So 5 marks you have to, so you, in fact, 4 marks, I would say. 4 marks for this part, 4 marks for this part, and 2 marks for conclusion. So overall, you can say that overall, the one company is performing good. Their financial performance is better than the market, and financial position is also strong. In one line. First, I make one straight away conclusion, and then you can make some other points. So you give an absolute. Overall, what is this? Overall performance is good. Financial performance is better than others. Financial position is also strong. Now, if you want to write down some more details, it is your choice. But conclusion you give in straight away. Very absolute conclusion. Conclusion, like when I write down these things, this is long. Conclusion is always absolute. Conclusion is like yes, no. so that if anybody reads, so if my manager is reading or you are reading, so you don't have time of reading all this long thing. You just go to the conclusion. In one line, you understand. Overall, one company is performing good. Their financial position is better than the market, and their financial position is also strong. Performance is also good. Position is also strong. Now, if you want to speak other about what should do, you should say that, however, they should control. You should give some suggestions here. They should control the inventory holding periods as well as inventory holding period. And this can be achieved by giving discounts, as they have sufficient profit margins. That's all, nothing else. So you are the manager. You don't read anything. You say overall the one company is performing good. Their financial performance is better than the market, and financial position is also strong. You can write down with lower debts and lower interest payments. So this is done. However, and then we are making any suggestion. They should control the inventory holding cost. This is our only problem. And this can be achieved. You are also giving suggestion. So you are identifying the problem and you are giving the suggestion. And this can be achieved by giving discount, as they have sufficient profit margins. So profit margins we also mentioned. So we do not only say that give discount, because if you write a note to me and say that, please give discount. So what immediately comes to my mind, can I give discount or not? Do I have margin or not? So you also mentioned as they have sufficient profit margins. This is how this entire question should be answered. Now I took a lot of time because I was explaining, but you should be, when you are doing it, just remember that, are you comparing industry, you are comparing individual, you are doing your past performance, current performance, and it's very important to understand the scenario. Read the question, understand the scenario. We had two problems. One problem was inventory valuation. One is inventory slow movement. One is this, whatever, the asset stuff. Any questions you want to ask?